There's a simple formula investors use to judge if a company's growth is actually sustainable. It's called the Rule of 40, and it can tell you in seconds whether a business is scaling efficiently or burning cash. If your growth rate and profit margin together hit 40% or more, you're in the safe zone. Drop below that, and you're signaling the opposite. That growth might be costing more than it's worth. The Rule of 40 is simple. You just add your revenue growth rate and your profit margin. If the total hits 40 or higher, your business is striking a healthy balance between growth and efficiency. It shows you're scaling sustainably. You're not trading long-term stability for short-term spikes. But if you fall below 40, that's a signal your growth might be coming at the cost of profitability. Here's why it matters. Let's say your company is growing fast, revenue's up 60%, but you're losing 25% in profit. Add those together and you get 35. That's below target. It tells investors growth is happening, but it's expensive growth, the kind that burns cash instead of building a foundation. Let's look at how it plays out. A company growing 30% with a 10% profit margin hits the Rule of 40 right on target. That's healthy growth. But another business growing 50% while losing 20% lands at 30. That looks fast from the outside, but it's burning through cash underneath. When you compare companies side by side, you'll notice a clear split. The one on the left is growing fast, but the profit trend dips. It's all expansion, no margin control. The one on the right, however, grows steadily while keeping profits positive. And that's what pushes its Rule of 40 score higher. Investors prefer that second pattern, slower but sustainable. If your Rule of 40 score is under 40, you've basically got two ways to make the change: grow smarter or become leaner. To lift growth, test new pricing models, strengthen your recurring revenue, and keep churn under control. On the profitability side, cut unnecessary spend, automate repeat work, and focus on products or clients with the best margins. The goal shouldn't be chasing higher numbers. You need to balance speed with sustainability. That 40% mark isn't random. It's a quick health check investors use to see if growth is actually sustainable. A score above 40 means your business is scaling efficiently. Drop below it, and it signals potential issues with cost control or scalability. That's why companies that stay above the line tend to earn higher trust and stronger valuations in the long run. From an investor's view, a Rule of 40 score isn't just a number. It's a shortcut they use for judging efficiency. When your score rises from 40 to 45 or 50, it signals you've found that sweet spot between growth and profitability. Higher scores usually translate to stronger confidence, better valuations, and easier access to funding. On average, SaaS companies sit around a Rule of 40 score of about 35. The high performers hit 50 and the best in class reach 70 or more. As that score climbs, so does valuation. But it's not just about growth. Investors reward efficiency because a balanced score shows discipline and speed. Marketers have changed. Growth alone doesn't impress investors anymore. Efficiency does. That's why the Rule of 40 has become more than a benchmark. It's essentially now a survival rule. Companies that master this balance aren't just scaling fast, they're built to last. In the end, growth only matters when it creates real value. The next step